My name is Jake. Welcome to the channel. I want to talk about the best growth sector ETFs out there. Now, in previous videos a couple of months ago, I made a few videos around the best growth ETFs, the best value ETFs, and the best monthly dividend ETFs. Now, this video is going to be very similar in format to those other videos, but this video is going to be pretty different because sector ETFs are really different from just growth ETFs in general. And so I went down a pretty steep rabbit hole here when trying to understand what constitutes as the best growth sector ETF. And I want to share with you my methodology around how I came to the conclusion that these 5 sector ETFs are the best. I'm going to share with you kind of what I was thinking about, why I chose these, because generally if you go and watch another video or you read a blog and it says in the title, the best of anything, the best growth stock, the best semiconductor stock or ETF, like generally, they're just sharing their opinion. And that's all it is their opinion. Some articles and videos will go and show the hard data. In this video, I want to share with you in detail the methodology that I took to come up with this list. And then towards the end of the video, I'm going to stack rank all of the ETFs, share all of the information side by side so that you can see, how they compare with each other. The ETFs that we're going to talk about are VIS, VDC, VHT, VCR, and VGT. So the methodology for selecting the ETFs for this video, the considerations that I made was I first looked at the volatility of the companies in each individual sector, as an index as a whole. I looked at the total performance, so the capital appreciation plus the dividend. I looked at the valuation of the companies based off of price to earnings ratios. I looked at future earnings per share projections. I looked at the expense ratio, made sure that they were very low. I made sure that they were only market cap weighted, and I made sure not to cherry pick any single data point. I really tried to focus on the data and really make it so that it was factual and not just my, my opinion. And I do want to make sure that we're talking about, sector ETFs here. This is more suited for a satellite position. If you follow the core and satellite approach to investing that I talk about on my channel, this is not something that you would invest more than 10 or 15% of your overall portfolio in it. It's more of a smaller position, but it's to add a little bit more growth to your overall portfolio. Growth is generally focused on future cash flows, whereas value is focused on current cash flows. That's the big difference here. And so we're not skewing it towards anything in terms of dividends. This is just pure total returns growth. I got a ton of stuff to share with you in this video. I hope that I can record this video without too many interruptions. If you have kids, you know that they can be a little bit unpredictable. And, for whatever reason, whenever I start recording, my son, he's a toddler. He always loves to come and, he's curious. And so he's always like interrupting me when I'm in my flow. And, it's kind of looks a little like this.
Everybody, I'm Stephanie. Everybody, I'm Stephanie Quayle. Everybody, I'm Stephanie. Hey, everybody, I'm Stephanie Quayle. Hey, everybody, now is he pooping? Yeah. Okay, great. Hey, I'm Stephanie Quayle. Hey, I'm Stephanie Quayle, born and raised. Hey, everybody. Take number 140.
Oh my gosh. What got me is when she said, did he poop yet or did he poop again? It was so relatable with my little boy. Oh my gosh. Being a dad, I never thought I would say, did he poop or did he have a poopy? So much. Yeah, fun times. I want to share this really quick before we dive into the video is the DJI to Fi community that I created. I've been on YouTube for over 4 years. I've always, I've never had a community or a Patreon or a Discord or anything like that. And so the DJI to Fi community, it's more of a personal community focused on a couple of things. The first thing is to engage with me and other like-minded investors. This is a WhatsApp community, so you're able to join and, connect with me and other other investors on different topics that are interesting to you. So for example, if you have a question, you can ask me directly on WhatsApp or anyone else in the community. The next thing here is to meet. We'll have, you'll be able to participate in virtual meetups. We'll do that on a regular basis. I'm really excited about the virtual meetup. Then the next thing here is to connect. You'll be able to build a personal connection with me and other dividend investors in the community. And then the last thing here, if you've been following my channel for a while and you've got value and my videos have helped you in any way, this is a great way to support the channel by joining the community. So that's the DGI Defy community. I hope that you would consider joining. So the first ETF that we're going to take a look at is VIS. This is from Vanguard. This is the industrials ETF here. This is just focused on industrial companies here in the United States. And whenever you're looking at an ETF, there's a couple of things that you want to make sure that you're mindful of. The first thing is you want to take a look at the expense ratio. You want to see at the assets under management, all of that good stuff. But the very, very most important thing is the methodology behind the ETF. Now, all of these ETFs that we're going to talk about today, they all follow the same index, the same format, okay? And so this is the ETF. If you're on Seeking Alpha, you can go down and you can see under the fund profile that this is the methodology. So when you invest into an ETF like this, what you are doing is you're investing into this. Okay, you're not investing into some arbitrary shenanigans, right? You're investing into whatever this index does. Now, you might be asking the question, well, what the heck is the MSCI US Investable Market Index? Blah, blah. What is that, right? Like a foreign language to many people. What it is, you can Google the index name and it will pull up a fact sheet similar to this. And what it is this index, it captures the large, mid, and small cap segments of the U.S. equity universe. So every company within the U.S. that fits under this category, right? That are classified in the industrials sector. So with this, no more than 25% of the value of regulated investment companies' assets may be invested in a single issuer at the sum of the weights of all issuers representing more than 5% of the fund should not exceed 50% of the fund's total assets. This is kind of word salad here, but it's a way that they balance the weighting of the individual companies in this index. Another thing to note here is that the index is rebalanced quarterly. Okay, so that's how this index is set up. And if you were to do this for all of the others that we're going to take a look at, it's the same framework for all of them. So coming back here to Seeking Alpha, a couple of things that I want to take a look at. The first thing that I want to take a look at is the holdings here. So when we take a look at the holdings of this ETF, you can scroll down here and you're going to notice that there's a lot of companies that you're probably familiar with, right? Deere & Company, General Electric, Boeing, Caterpillar, Honeywell. A lot of these companies are very, very well known. They're international. Something that I really like to look at is I like to look at the number of holdings in general, as well as what percentage of all of the total holdings are represented in the top 10 holdings. Okay, so more or less, how concentrated is this ETF in its top 10 holdings? And all of these ETFs, not all of them are created equal, not all of them are similar. So this is the Vanguard Industrials ETF. Let's take a look at the next one. The next one is VDC. This is the Consumer Staples ETF. Now, I want to take a second and say that this really shocked me that I put this ETF as a growth ETF, because when you think about growth, you generally don't think about staples. But if you go back and you backtest the performance of this ETF, it's actually outperformed the other sectors in the market, which blew my mind. Before you write a comment in the comment section saying, why is he saying consumer staples? I was as shocked as you were. You are, okay? So just want to make sure that that's clear. So you want to make sure you're taking a look at the expense ratio, the assets under management. Assets under management is nothing more than just, what is the liquidity of this ETF, as well as how popular is the ETF, right? And then when you look down at the fund profile, like we saw with the other one, it's the exact same framework. And what I like to look at is, like we did with the other ones, is the holdings. Now, the holdings, you can see here that the top 10 holdings are going to be companies that you as a consumer know. It's Pepsi, Procter & Gamble, Coca-Cola, Costco, Walmart, etc. And something to really note is that the top 10 companies in this index represent 61%. So this is a very concentrated ETF. Okay, so, and then towards the end of the video, I'll go and I'll stack rank all of them and I'll show the performance here in a second. But yeah, consumer staples. I was pretty shocked by that. The next one here on the list is the Vanguard Healthcare ETF, okay? Very similar in terms of expense ratio, assets under management. It follows the same index. When we look at the holdings, you can see here that there's 421 holdings, companies like United Healthcare, Johnson & Johnson, Eli Lilly, Merck, AbbVie, and the top 10 companies in here represent 46% of the index. This is very concentrated. Generally for me, I don't like to see more than 25 or 30% of concentration, but that's just me personally. And every index is obviously going to be different. But this is the third one here in the Vanguard Healthcare ETF. The next one is the VCR, the Vanguard Consumer Discretionary. So consumer discretionary is a lot more cyclical. When you think about staples do very, very well in a defensive down market. Okay. In a bull market, staples generally don't do as well. They're more seen as a safe haven. Now with consumer discretionary, when times are good, when there's a lot of money available in circulation, when consumers have money, they spend it. And companies that benefit from that extra spending are generally held in an index called the Consumer Discretionary Index. Okay, and similar to the other ones, expense ratio of 0.10, assets under management, 5 billion. But this is what's interesting. I actually didn't know, well, I think I knew this, I forgot. But what's really, really interesting is the top 10 holdings. And I think this is so cool. So cool and, I guess scary at the same time. But what I want to highlight here is first, number of holdings. There's 311 holdings. The top 10 represent 61%. But here's the thing. The second largest holding of this ETF is Tesla. The first is Amazon. Now, Amazon is just massively, this is a lot of allocation to Amazon. With Tesla as well. But here's the cool thing. A lot of people, they want to invest in a Tesla, but they don't want the risk, right? And there's a lot of companies, there's a lot of, so-so ETFs out there with high expense ratios that I personally am not the biggest fan of because of the high expense ratio. Is example, Kathy Wood and the ARK ETFs, right? The largest holding is Tesla, but the expense ratio is massive. If you wanted to invest into Tesla from an ETF, get exposure to Tesla, this is a great way to do it. It's a market cap weighted index and it has a low expense ratio. So if you did want to get exposure, you wanted to get in on the action with Tesla, this may be something interesting to consider where you're not taking the single stock risk, but you're benefiting from the growth, okay, because it's market cap weighted. I thought this was really interesting. The one thing though is, Amazon is a little bit high, 23% is a little bit high, but if you really, really wanted to get exposure to Tesla at a low expense ratio, at a reputable issuer, right, with Vanguard, might be something to consider. So I thought that was really, really interesting. The last one here that we're going to take a look at, and in terms of full disclosure, I do personally own this ETF. My son Lucas owns this ETF. We have invested for him. And this is one of my largest holdings in my Roth IRA. I have over a 25-year time horizon in my Roth IRA. And so yeah, this is one of the ETFs that I invest in. But similar to the other ones, same expense ratio. This has the highest assets under management. The holdings here, you're going to kind of have it similar to the discretionary ETF that we just took a look at. The largest holdings are going to be Apple and Microsoft. Now, when this ETF rebalances, I think that Nvidia is going to make up a larger percentage of this ETF because they've just ballooned in market cap. But I guess we'll see how that works. But yeah, so you got 325 holdings, 62% in the top 10. This is another great example. If you wanted to invest into Apple, Microsoft, Nvidia, Adobe, but you don't want the single stock risk, this is a great way to invest into growth stocks without the risk. But you get the upside, right? You get all of the upside, and I would argue almost none of the downside, because if they go down in value, it's just going to be represented less and less in the index, okay? But here's the thing. You're not going to see a 500% increase in a single year where you may with like Nvidia or Tesla. That's the caveat there. Okay, so you're not going to see that, but you're also not going to see the drastic downside, in a down market. So you got to pick and choose what's important to you. Me personally, as a conservative risk taker, I guess you could say, I much prefer this approach to growth investing. All right, now let's take a look at them side by side and let's see how they compare to the S&P 500. So what you're seeing here is the total return. This is with the dividend reinvested. The S&P 500 here is in a purple, is here towards the bottom. Though, what's really interesting? Whenever you look at charts and you see historical performance, up until 2020, everything was like neck and neck. It's so interesting. And I guess the question is well, when does it come back to the mean? When does it revert back? I guess we'll find out. But anyway, so you got S&P 500 down here. The best performer here is going to be VGT. This is not really surprising because it's got Apple and Microsoft in there at the highest weighting. You got VHT at 552%. The second best performer is VCR. This is the discretionary ETF here. This is with Tesla and Amazon. Over here, you got healthcare, you got industrials, you got consumer. Okay, and so with the S&P 500 and the staples, they're pretty similar. But what that means is all the other sectors since 2005 have underperformed the S&P 500. So it's really been carried by a few of these ETFs in terms of, the performance of the S&P 500 has been so concentrated. And, I don't have a crystal ball. I don't know if that's going to continue, but it's definitely worth noting that that's been the case. And whether that's going to continue, I don't know. Who knows? I'm personally a big fan of Seeking Alpha. I use them in most of my videos. I've been using them for years. I've been using Premium for over a couple of years now. I really am a big fan of it. I use it on a regular basis. I read the articles that, from different, authors that I follow, the different charting, the financial metrics. I personally use all of that. If you do want to sign up to Seeking Alpha Premium, you can use my link and you can get a coupon code with my link to get also Alpha Picks. So Seeking Alpha is no longer discounting their price. You're not going to get a discount on it. But what you will get with my link is you'll get Alpha Picks in addition to your Seeking Alpha Premium subscription. So if that's something that you're interested in, you'll be able to get that with my link. And it is an affiliate link, so I do benefit from it. But if you are going to sign up and you want to support the channel, I really appreciate it. But as always, no pressure. Something that's also really important is to understand fund overlap. So if you're investing into multiple ETFs, how much overlap are you getting by investing into both of those ETFs? One thing that I like to do is I really like to compare the overlap of an ETF with the total US stock market. So if there's massive overlap, and you're investing into both, the question is why? Why are you doing that? So you want to make sure that you understand the methodology and you understand the fund overlap of the investments that you're investing in. And generally speaking, in my opinion, the more overlap with the total US stock market, it's a good thing. Now, not everyone's going to agree with me on that. But me personally, because I don't have a crystal ball, because I'm kind of a bogle, not a purist, but I do kind of believe that the market is efficient. The market is going to do what it's going to do. And we peasants can't predict the future. And so I like to mimic the overall market as much as possible. But I'm definitely not a purist when it comes to being a boglehead. So you got VTI here and you got VGT. When you're comparing the overlap of VGT, this is the technology ETF versus VTI, there's 26% overlap. That is quite a bit considering it's a sector only ETF. Okay. Now, when you compare that to the consumer staples ETF, there's only 6% overlap. So really not a lot. So what that means is if you did want to go and combine more into this one, you absolutely could, and you're not going to see a lot of overlap. The next one here is the consumer discretionary one. Now this one is, for me personally, this one's really interesting. I'm almost interested in this one for my son Lucas. with a long-term time horizon, because you got Amazon and you got Tesla in there. I wouldn't buy them Tesla outright. I'm too risk averse for that, I guess. But if I wanted to get more exposure to Tesla, this would be, in my opinion, this is a way that I probably would look at this and say, hey, I could definitely do this. I'd much prefer to get exposure to Tesla through this ETF than through investing into Tesla directly, or through, ARK and Cathie Wood. But that's just my opinion. If you want a conservative risk, this may be something to check out if you're specifically interested in Amazon or Tesla. Okay, let's take a look and let's benchmark each one of these ETFs, and let's take a look and see how they compare. So you got the first one. This is VIS. This is the Industrials ETF from Vanguard. They all have the same expense ratio. So if you were to invest $100,000 into these ETFs, you would expect to pay, $100. Now, this is not you writing a check or them deducting any money. This is the price that would be automatically deducted from the ETF. So there's nothing that you pay. It's just deducted from the NAV, the net asset value of the ETF. They were all created in 2004. VIS has assets under management of $5 billion, has 392 holdings, the top 10 weighting of 28%. It has 10% overlap with VTI. So VTI is the total US stock market. Over the last year, it's been up 16%. And over the last 10 years, annualized, it's been up 11%. This is annualized. And since January 2005, it has a total performance of 415%. The next one here is VDC. This is the consumer staple ETF. It has $7 billion in assets under management, has 108 holdings. It has 61% in the top 10. That's quite a bit of concentration for me. It has 6% overlap with VTI, only 5% total performance this last year, and 9% annually, but surprisingly, since 2005, so this ETF has experienced two crashes, 08, 09, and the pandemic, and it's up 463%. This is why, this is really, really interesting to me. I never expected to see this on a growth list, okay, honestly. And then the next one here, VHT, this is the healthcare ETF, 17 billion in assets under management, 421 holdings, 46% in the top 10 weighting, 13% overlap with VTI, only up 2% over the last year, but it's been up 12% annually since the last 10 years. And it has total performance since 05 of 552%. The next one here is VCR. This is the consumer discretionary ETF. It has $5 billion in assets under management, 311 holdings, 61% in the top 10 weighting, 11% overlap with VTI, 7% performance over the last year, and 13% annualized over the last 10 years, and it's up 565% since 2005. Then the last one here, VGT, this is the information technology ETF, has 52 billion in assets under management, has 325 holdings, 62% in the top 10 weighting, has 26% overlap with VTI, which is not surprising because the total US stock market is primarily comprised of technology companies, Microsoft and Apple, so that's not too shocking. The last year's performance, it's been up 16% in 1 year, and over the last 10 years. I had to double check this, but this is correct. Over the last 10 years, it's averaged an annual return of 20%. That's with the financial crisis of 0809. That's with the crash of 2020 kind of crash. It kind of was a V recovery. But on an annualized return, if you held this ETF, you're up 20% year over year for the last 10 years, and you're up almost 1,000% since 2005. I can't stress how important this is to understand. If you're investing for the long term, investing for growth and investing for total returns is absolutely vital if you want to, be able to get ahead and not, suffer to inflation like we're seeing today. So if you want to outpace inflation, you have to take a little bit more risk, endure a little bit more volatility, because I promise you, the volatility of this over the, during those crashes, the volatility was insane. The NASDAQ was down over 35% from peak to trough here just this last year, but it just came roaring back. I hope that this shed a little bit of light on how the different sectors in the S&P 500 and the market, how they work and how they're different. And really, if you're just an average investor and if you're watching this video, what I would hope that I can drive home here is over an extended long period of time. That's why I put in the title of this video for long-term investors. If you have a multi-decade time horizon, investing into growth and enduring that volatility, in the short term can pay off greatly in the long term. Thank you so much for watching, everybody. I hope that the video was helpful. I hope that you learned something new, and I hope that you would consider joining the DGI to FI community. And I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.